Good morning and welcome to Keiter's final state and local tax webinar for the year. Today, Kay Gottschall and I are going to be talking about sales and use tax audits and some practical advice. We're finding that a lot of our clients are currently under audit by Virginia or possibly other states. So this webinar is very timely. So welcome, and we'll get started with the presentation. First, our normal disclaimer is, our presentation doesn't constitute professional advice. It's just general guidance. You can't rely on it, blah, blah, blah. You kind of know the drill. But note that, for the CPE credit, we are verified with Virginia. If you have in other states CPE requirement, you might want to check with them regarding the availability of CPE credit. For some administrative or housekeeping before we get started with the presentation, a lot of you are looking for CPE credit, and we are too, especially at the end of the year and especially during this challenging COVID year. But to receive CPE credit, you must stay connected to the program for the entire time, sign in to Zoom using your first and last name, and respond to 3 of the 4 polling questions. And they'll pop up on your screen. It's a lot easier than it was when we first started this whole webinar process. Also, you must complete the evaluation that you'll get with an email later on or after the completion of the webinar. And assuming you meet the CPE requirements, we'll send you a CPE certificate within about 14 business days of the webinar. So, just sit back and enjoy, but just be aware that CPE cannot be awarded, if you are, participating over the phone, participating in a group, you don't respond to the questions. And so just be sure you respond to the questions if you need the CPE credit. I'm Terry Barrett. I'm one of your presenters today. By way of background, years ago, I worked with the Virginia Department of Taxation, focusing on sales and use tax matters. Since then, I left the department. I've worked for Big Four. I've been with Keiter. So I've been on the other side of the equation, assisting clients with their sales and use tax audits. So I've had a lot of experience with this. My other presenter, Kay Gottschall, I'm going to let her introduce herself, and Kay will take over the presentation from here.
Hi, good morning, everybody. I'm Kay Gottschall. I know a lot of you guys on the call or on the webinar, so thank you for joining us this morning. I have been with Keiter, I guess, going almost on 20 years now, and I focus primarily on income and franchise taxes, and primarily on compliance and consulting with clients as far as nexus, exposure, filing tax returns, and then dealing with audits as well. So let's get started into the meat of the presentation. Learning objectives. Let's try and be better prepared in advance of a notice of an audit. We're also going to talk about better understanding the audit process and the rights as a taxpayer, making sure you guys are aware of some key focus items that the auditors are going to be looking at. And then also the do's and the don'ts during an audit process. I mean, we have some pretty bad horror stories, but hopefully we've also had clients who have done really well in areas. So as far as the agenda, just real quickly, we're going to talk about audit preparedness, talk about reasons about why somebody might have been selected and what you can do before the audit actually starts. Going through the audit process, typical information that people request or that the auditors will request, waivers, statute of limitation waivers, what they mean, what recommendations are, what happens after the audit, and then some hot topics and things that the auditors look at. And then hopefully we will have some time for questions and answers. But, we do encourage questions. Usually when we do our presentations, sometimes I'll have candy, but that can't do that right now, so sorry. But hopefully if you do have questions, you can put them in the questions and answers, and our host, Claire, will go ahead and send us the questions in our chat box for me and Terry, and we will try to answer them during our presentation. So please feel free to ask us any questions. We would love to help answer your questions. So on to the first polling question. This is to help us kind of focus some of our comments to see who is in what different industry. So what industry below best describes the business that you work with? So your polling question is, should be on your screen. You should be able to select which one. And I'll give a minute for everybody to make a selection. As you know, there's no wrong answer. And we'll get kind of the results so that we can kind of see if people, should we focus more on wholesale, manufacturing? Obviously, manufacturers are probably going to have more use tax issues because most of their sales will go to resellers who will be reselling them. So it'll be interesting to kind of see where our audience, what industry our audience is primarily coming from. So go ahead and answer the first polling question. This is for CPE. Even if you don't have CPE or need CPE, if you want to answer it, that'd be fine too. So hopefully we will get a response and people. I think we're close to a minute, Claire. We pretty much have everybody answer these questions. So about 94%. I'll give a few more seconds. Okay, let's go ahead, I think, and close it. I think it's been about a minute. So we have most are in other. So great. Most of our audience is in other. So maybe you guys are either accountants or in other, but we do have mostly from retailers, about 15% from retailers. So we'll hopefully answer a lot of your questions or hit on a lot of topics that you guys have an interest in. So as far as the next slide, audit preparedness. Now, this is not preparing, this is preparing for an audit even before you get an audit notice. So these are items that you should be doing once you have a requirement to collect sales and use tax. So you want to definitely develop and follow comprehensive procedures. And those procedures can be how to properly collect sales tax, assess sales tax, self-assess use tax, how that's going to be reported. So those procedures, helping the employees to follow a procedure is going to make sure that the collection and the remittance of sales tax is more accurate. Also, you want to make sure you obtain and keep any type of exemption certificates so that you can rely on those when you are audited. Getting these exemption certificates before an audit after the transaction is not advisable. So we always recommend you make sure when you don't charge sales tax, you have an exemption certificate, and you make sure you review them. But Terry's going to talk more about exemption certificates later on, because it is probably the most important, one of the most important items that helps to alleviate any type of assessment. You want to document any sales tax paid on invoices. So when you purchase fixed assets, if you aren't charged sales tax, you have to self-assess a use tax more than likely, unless there's an exemption for it. You want to keep contracts and for your customers and vendors, on a periodic basis, or when you have new products or services, you want to review the taxability of that. This is key. You want to reconcile your GL accounts. Funny story, and it's probably not funny, but I was giving a presentation, and one of the participants in the meeting, in the presentation, said, "What do I do with a sales tax payable account that has $100,000 liability? I don't know who to pay it to." And I was like, you need to reconcile it and pay it to any state. Like, you can't write it off into income because if you get audited, they will want that money if you don't have it reconciled. So please reconcile GL accounts quarterly, monthly, recommend monthly. Also, you want to review your multi-state nexus and perform a nexus study. Periodically review where you have nexus in states. If you haven't heard the wonderful Wayfair case with the Supreme Court case, we're not probably going to talk a lot about that. I know we normally do, but the economic nexus, you need to be aware of those in your requirements to charge sales tax, collect sales tax on behalf of your customers and remit it to several states. And then last but not least, provide training to your employees. You know, the AP people, the accounts receivable people, your purchasing people who, you know, who are going to be giving and receiving these exemption certificates. You know, train them on what to be looking for. That'll definitely help and go a long way as you prepare for any particular type of audit. So next slide. If you do get a notice of audit, you're probably going, why am I getting selected? So some reasons why you may get selected is you may miss a filing of a return, you may pay something late, you may be filing several amended returns, so they may then select you for audit. I mean, filing one amended return is not necessarily going to be where you get selected, but multiple, sometimes that could be it. Now, this is a big one that I've seen a lot of, where your customer, the person who you sell to, gets audited and they see your invoice gets selected. And if the sales tax is not properly charged, you will definitely get selected for audit for that. I've seen that quite a bit, even from other states. North Carolina has contacted several of my clients because in Virginia, because they didn't charge sales tax properly on their invoice. You know, news articles, you know, if you're in the news about how well your business is doing, or the big sales that you have, or advertising that you may have, you may get a complaint by a customer or a competitor that you aren't charging sales tax properly, and they are. That could be a problem.
And let me jump in real quick, Kay. I mean, we see this fairly often. Is like, you know, some of our clients complain, well, I'm collecting the tax, I'm trying to be compliant, but my competitors are not, you know, or vice versa, they're collecting and I'm not, you know, what's the right story? And, you know, or why am I being audited and they're not? Eventually everybody will be audited, but it's a potentially a big issue. So if you have decent relationships with your competitors, try to get on the same level play, you know, same playing field. You know, you're either collecting or not, because that way one audit won't necessarily trigger another.
Yeah, and I think, Terry, you were telling me you were talking to an auditor, and that in Virginia, at least, that they are now, the auditors are actually responsible for getting audit candidates. Mm-hmm. So they may select a particular industry and then audit everybody in that particular industry, because they know all the issues, they research all the issues, they know what to look for. So we have seen that quite a bit. I think it was, but they will, particular, like construction industries.
Contractors, yeah. Yep. Contractors are big right now.
So
yeah,
unfortunately. So there's many reasons why a particular company may get audited. So as far as ways to help minimize, basically timely file your returns and pay your tax, timely respond to notices, you know, make sure that you are registering for use tax if you're not charging taxable sales, because normally 99% of the time you're going to have some type of self-assessed use tax in a business. You're not going to get charged tax on everything. Make sure you're properly invoicing your customers, again, because then if your customers get audited, you know, they'll have the correct use sales tax being charged to them. And then this is a big item. One of my clients got audited because they were filing their sales tax returns. Normally on a sales tax return, you start with total sales, and then you subtract out sales for resale or exempt sales or sales to other state, and then you come down to whatever the taxable sales are in that particular state. Well, some people will just put the total taxable sales as total sales, and then when you add up all of your quarterly or monthly sales tax returns, they do not tie to your tax return. So a lot of times we will file an income tax return in that state and we report all the sales. So if your total sales on your sales tax returns are not similar to what you're reporting on your income tax return, that could be a triggering event for them to come and audit. So you definitely want to watch that. Make sure you're working with your income tax preparer, or what's on your GL. I mean, when we do income tax returns, we tie it to the GL. So next slide. So pre-audit considerations that you want to think about would be to establish an audit team, maybe select a point of contact. That could be an employee, an officer, or a key employee in the finance or audit accounting department, or even a contractor.
Or Kay, it could be Keiter. We do assist clients with this, so just a quick plug there.
Absolutely. You want to make sure you look at your level of compliance, identify any major risks, try and minimize the risks. Obviously, you want to minimize your risk before you actually get a notice audit for an audit. You want to make sure you have your research and documentation on your positions of your taxability of your products or the non-taxability of your products and services. You want to maintain your normal compliance, like don't stop filing sales tax returns. You want to continue to file and be compliant. You want to make sure you've got records available, or you know what records you have available according to your retention policy. You want to plan the timing of the audit. Try not to plan it in the middle of your busy season. You can postpone some audits, but you can't continue to postpone them, because then you don't want to make sure you also get them done, because the more you drag it out, the more less happy, I guess, the auditor is. And also communication is key. If you do postpone an audit, make sure you're communicating with the auditor. I mean, there can be issues that arise where you would need to postpone it a second time, but you would need to make sure you're explaining that all to the auditor.
Yeah, and right now, COVID is a good excuse for postponing an audit, and we're seeing clients use that. And we recommend that if it works for you, if it's not a good time for you to be dealing with an auditor, having an auditor on site, or reviewing your records, it's a good excuse, and it's a valid excuse. And so it's not like one that's going to count against you with the Department of Taxation. I mean, they'll accept that as a valid excuse, and we'll work with you on that. So even if it's really a real excuse versus you just want to kind of put it off a little bit, you can use COVID.
So next slide. The typical audit process is you get a contact from an auditor, and I have had them call me on the phone, which I don't like, but they do. They'll call the client, and the client tells them to call me, and then I get a power of attorney. So they will contact you by phone, and then they usually always follow up with some type of letter in the mail. So I don't generally give them much information. I don't tell them a lot on the phone. I wait till I get the documentation from the auditor in the mail. And generally they will then send you in the mail an IDR is what the IRS call them, but their information document request or request for information. It's a schedule of everything that they are requesting. And then they schedule either a desk audit or an on-site visit. Sometimes, a lot of times, as Terry knows, they will come to our office, and we get to babysit them and make sure they're not walking around or looking at anything that the client has. So we do have offices for auditors specifically down in our dungeon, as we call it now. But you have an initial meeting, you discuss the process, you tell them information about your company, the processes that you have, discussing how well your procedures are. If you have sales and use tax procedures, and showing them those are always go a long way when you're talking to an auditor. They feel like you're competent, you know what you're doing. Review they'll review the information you provide. They'll ask for more information, and sometimes more information. There could be several information document requests. And then they issue a preliminary result. They let you, try to provide more information. This is where coming up with exemption certificates and locating exemption certificates and providing more to get the error rate down really helps. And then they issue a final assessment. They issue their work papers, and you get an assessment in the mail. And then you have so many days, depending on the state, to either appeal that assessment or pay the assessment. And that's a typical audit process for most either income taxes or sales tax audits. So on to polling question number 2. How many years has the company that you work for been audited in the past? Is it 1 year, 2 years, 5 or more years, or never audited? So again, there's no wrong answer. Be interesting to see how many people have been through an audit or two or never audited. Hopefully, you could, hopefully you guys have never been audited and you'll never will be audited. So, and then we just got a question while you guys are filling that out from one of our, Mike Grasek. Is the audit process still a sampling type audit? So yes, it is still a sampling type audit. Terry's going to go into a little bit more detail, or actually I'm going to go into a little bit more detail on the next slide about that.
Yeah, we'll talk about that.
Yeah.
Yes, they do.
I'm sorry, go ahead, Terry.
I said, yes, they do sampling with respect to certain types of purchases or sales, but there are detailed audits with respect to others. So you'll talk about that in a few minutes today.
Yep. So I think we're just about done. We have about 92%. So we'll give another second or two. Another question from Mike. Do they tend to stay away from professional services firms like legal and accounting and engineering? As far as professional services, they would, if they were to audit professional services firms, they would primarily focus on, at least in Virginia. Now, it could depend on the state, because some states, such as West Virginia, I think, actual tax services, but Virginia typically does not. So they would focus on the use tax. I mean, a company that I worked for, which was a manufacturer, when we got audited by the state of California, they focused primarily on use tax, not on sales tax. They didn't really look at sales tax at all, because they figured we had exemption certificates. So they made a few selections of big sales, but then they focused mostly on use tax and self-assessing use tax.
Right. So it's a tax on your purchases that you're using in your day-to-day businesses. And we'll talk a little bit more about the whole use tax process in Virginia's rules and other states' rules as we go through the presentation.
Good. So it looks like, 45% never audited. Lucky you guys.
Wow.
So
great.
And it's good that only 5 or more years are only 11%. But unfortunately, there's still people who get audited. Once you start getting audited, sometimes I think they come every 3 to 5 years or something like that. So, well,
a lot depends on the amount of liability they find. I mean, if they find a small amount of liability, like $5,000 or less, for a 3-year audit, state's not going to come back and audit right away. I mean, they're going to give you some time. I was talking with a client yesterday. The last time they were audited was 1994. So, and now it's 2020. So it's been some time. And unfortunately, one of the issues raised by the auditor was something that hadn't been raised in 94.
Oh, no.
So it's an issue now. It wasn't an issue then. So, but yeah. Yeah.
So let's go ahead and move on to, real quickly, let me answer the questions that have been put in our chat box. How often do you need to update sales tax exemption certificates? I'm going to let Terry address that when she talks focus. She has a slide focused primarily on exemption certificates. I'll let her speak to that in a minute. And our auditors focus on fixed assets, which is a great lead in to our next slide. Thank you very much for keying that up. So 3 parts that audits generally will focus on. Okay, they almost always, every sales tax audit that I have been through, and Terry could probably agree, they focus on fixed assets, and they do usually 100% of fixed assets. They will look at every acquisition you make and make sure you have either paid sales tax or self-assessed use tax on the acquisition of fixed assets that are being used in the company, or you have some type of exemption certificate. And that exemption certificate can be, it's used in R&D, it's used in manufacturing, those type of areas. But again, I'll let Terry speak more to the exemption certificates.
Well, and two, you know, regarding fixed assets, one of the issues is not only acquisitions, it's dispositions. So if you're disposing of equipment that you no longer need or use, you know, the states will be looking at that as well. I mean, if you're regularly engaged in some sale of tangible personal property and you dispose of a fixed asset that you no longer need, the state will, Virginia and most states will look to see if you collected the sales tax on that disposition of the property, of the fixed asset. If you're not normally engaged in sales of tangible personal property, then, you know, one could claim an occasional sale exemption, like it was, you know, 1 to 3 sales during a given year are not subject to the tax. But so that's something to be mindful of, is that what you're regularly doing as far as business. If you're regularly engaged in sales of tangible personal property and you sell, you know, some, you know, computers or printers, what have you, they might be assessed in the audit process. So just something to be aware of.
So the other area of sales tax or sales they look at is they'll do a sample of sales. So they'll take your sales journals, they'll look at all your transactions, and they will make a sample selection, either a variety of months, they'll pick from a variety of years, they will sample invoices, they will review the invoices, they will determine if there's any errors, and they will calculate an error rate. So key is to try and keep the error rate or the error ratio as low as possible, because then they take that and they multiply it times the entire population. And sometimes if there's a high error rate or error ratio, it can lead to a very large assessment, because then they'll assess it. Usually they audit three years in a row. So during an audit period, I typically see 3 years. They'll pick 3 years, sometimes 3.5, but they'll have an audit period, and they will extrapolate that error rate along all the sales during that period of time. Unless you have some way to try and say, well, we put in a new system in a particular year, and there's some reason why you may have a higher rate or a lower rate. Obviously, if it's lower, you don't say anything and you just say thank you very much, and hopefully they go away. But if it is a particular high and there's a reason why it would be particularly high, you had you know, a different controller or a different system, ERP system or something, you can help to try and make a figure. You can try to argue some way to get it down or not use that error rate over the entire audit period. But that's generally not done, but you can try and do that if there's a particular facts and circumstances. Also, they will do purchases. This is for the use tax that Terry was mentioning. If you do purchase tangible personal property, or you're in a state that taxes services and you're not charged sales tax, you as a business need to have a procedure in place where you would self-assess use tax. Same with fixed assets. Or even withdrawing inventory. If you're a manufacturer and you withdraw inventory that you manufacture to use in the business. We had a client who was giving out samples of their product to their customers. Those samples are being used in the business for advertising, and you have to self-assess use tax on those samples that you withdraw. So there's typically, they will look at your purchases and other areas to self-assess use tax. So those are basically the 3 parts that they look at.
Right, and Kay, to comment on the sample periods, because sample periods are often an audit issue. I recently worked with a client, their sample period was 5 days. 5 days out of a 3-year audit period. It's because they had transactions, over 2,000 transactions a day. And so the auditors thought that this 5 days was representative of the entire audit period, which we are arguing was not representative. But so you have to be careful with the sample periods, you know, to be sure that you are agreeable with those. There's also a process, at least Virginia uses, where they do stratified sampling, where they pick certain buckets. I mean, they have certain buckets and they pick select samples from those buckets, but just be sure that whether it's sales and or purchases, that you are comfortable with the sales, with the sample period, because that's going to skew your audit results. So just be aware of that.
Okay, so next slide. Typical information that they request. In fact, we got another question regarding what is the statute of limitations. So generally, statute of limitations is 3 years after the date the return is filed. If you never file a return and there is an assessment, the statute of limitation is never goes away. There is no limitation on the statute. So keep that in mind. If you're not filing any use tax return, even though there's nothing due, the statute of limitations is always open.
Yeah, and to clarify that too, Clay, like in Virginia, if you've never filed a return, they'll go back 6 years. If they think, there's, fraud or, some other egregious activity, the state has the ability to go back farther. Other states won't stick to the normal 3-year statute of limitations or the extended statute of limitations. They may go back forever, but a lot of times they will limit the statute of limitations. And I think in the question that we had is with the 1994 example that I provided, where a client hadn't been audited since 1994. The statute of limitations in that situation is 3 years because it's the most current 3 years. The client had been filing sales and use tax returns. They had been filing what they thought was appropriate. And so now they're audited. And so the state is just looking back the 3 years. They're not going all the way back to the last time the client was audited, which is a good thing because there is potential exposure there. So just wanted to clarify that.
The other forms that they generally will ask for, if you engage your accountant or engage Keiter, we will get a power of attorney form for several accountants, and so that we can talk with the auditors. They'll ask for income tax returns. They'll ask for copies of sales and use tax returns. They'll ask generally for a chart of account, GL detail, and a trial balance. I try to stay away from giving them a GL detail and saying that they can make an audit selection. And I kind of try and push back on that, but I haven't really won that battle the past couple times. I keep telling them how voluminous it is to print, and everything now is so digital. They don't kind of say, no, you can give me it in electronic format. So I haven't really won that recently, but I used to be able to win it when I told them how big the GL used to be.
Well, and one defense for the clients is that, well, we can't print it. We don't have our system is so archaic, we can't print. I mean, we can't provide it electronically. We can only print it. And then the auditor's going, oh my gosh, I've got to look through 136 pages of GL detail. Do I really want to do that? So that's one strategy, to say, I can't provide it electronically. It has to be printed. And they'll go, oh, maybe not. So, yeah.
So next slide real quick, and then I'll go to another question that we got. Other items that they request: fixed asset detail and invoices. We talked about that. Sales journals and invoices of the samples that they've selected, customer contracts, exemption certificates. They'll for the invoices that they've selected, they will generally all ask for those. Purchase journals and invoices. This is to kind of review the use tax self-assessment, credit card statements and receipts, and then related party information like an organizational chart and those type of information. Again, most of this information they will want electronic format, depending on if they're doing an on-site and even if they are doing an on-site visit, they will generally want it in electronic format. Right. More recently, the audits have been, they come with their laptop and everything is on electronically.
Right. And a comment regarding the related party information, I generally recommend that clients don't provide that. I mean, until you absolutely have to, or you can even just say, hey, I'm not going to provide it, because what the auditor is doing is they're fishing for other audit candidates. So if you own, you have related parties, they might be in similar or even different businesses, and like, okay, well, I'm gonna audit ABC company, and they've got these subsidiaries or these, sister companies. That's an easy audit trail for me. I'm going to audit them all. My personal approach is to say, hey, look, we're auditing this one company, ABC company. Once we finish with this audit, we will then move on to the other, or we will then provide that related party information. A lot of times the auditors will forget about it and won't ask about it. Recently with an audit, the auditor kept asking me, like every few weeks, we need the related party information. I was like, oh, let me check with the client. Let me check with the client. At the end of the audit, she was like, well, we're getting ready to close this down. I need that related party information. And I knew the client didn't want to provide it. But I confirmed with him once again. I said, are we going to provide it? He said, no. He said, we're not going to provide it. And I told the auditor, I'm like, the client doesn't want to provide that information, period. End of story. Not to say that the auditor then couldn't have done her own research and figured out who were related parties, but she didn't, at least knock on wood so far. But, that's just something to think about. I mean, give them the basic information they want. But when it comes to related party, I would just say, oh, we're working on that, or we'll get that to you. Let's focus on the current audit right now, and then we'll get to that later on.
So, and now Terry's going to go ahead and talk about statute of limitations a little bit more. There was a quick question in the chat, Terry, I don't know if you saw it. Does a small business need to file a sales and use tax return even if they think there is zero due? Now, if you don't charge, like if the small business is in a service industry, or they're a manufacturer and they're not like a retailer where they're selling to end users, or their products are exempt, and you don't necessarily have to file a sales and use tax return, but we do recommend, as far as looking at use tax, generally there's probably going to be some type of use tax if you buy fixed assets or buy things that aren't over the internet from Amazon. I mean, maybe not so much now, but in the past there used to be, when sales tax wasn't charged as much. Now there's Wayfair, so I think more people are being charged now. But there usually is some type of use tax that has to be paid, where you would want to file some type of use tax returns, and that may be a monthly. You file it on a monthly basis for the whole year. It's kind of like unclaimed property. Do you want to file an unclaimed property return even though there's not much due? Not to go down that rabbit hole, but that at least starts the statute of limitations, which is a nice lead into Terry's next slide.
Right. And then to a clarification about the, filing a sales and use tax return. If you're registered for sales tax and you have no sales tax to report, you still have the obligation to file based upon the frequency set up by the Department of Taxation. So if you're registered for sales tax, yes, you need to file even if you're reporting zero. If you're registered for consumer use tax, or even if you don't have a registration, say if you're like a professional services firm, which I think a lot of our participants are, say like Keiter, we don't sell anything that's taxable in Virginia anyway. I mean, if we were in South Dakota, yeah, we would have to collect sales tax. But here, we might be subject to the tax on our purchases, computer equipment or things like that. So, presumably we have a consumer use tax registration and we're filing consumer use tax returns when we have tax to report. So that's the key. If you are, a services organization, not collecting tax, not registered for sales tax, you should have a consumer use tax registration, even if you're filing zero returns, because what that will do is if the state ever comes out and audits you and they say, oh, you're registered, you haven't been filing, we're going to go back 6 years. You can say, wait, no, I've registered, I've been filing, I've been reporting zero. You can only go back 3 years. And so that will limit the liability period. So definitely think about a consumer use tax registration. But, onto the next slide with the waivers of statute of limitations. Typically when an audit starts, the auditors ask for you to sign a waiver. It gives them, kind of preserves the audit period, for the 3-year period that they want to audit. No harm necessarily in signing that waiver. We get these questions all the time. It often, provides certainty as far as the audit period. So you know what your sample period is. It's not like it has to change every month because you don't have that waiver in place. Because if you don't have a waiver, essentially the first month of the audit period will drop off and a new month will be added at the end of the audit period. So it's kind of a rolling situation. So the waivers and statute of limitations are good in some respects. When it becomes a problem, though, is when an auditor is like dragging their feet, it's taking them forever to respond. They're not responsive. You're doing all you can to provide information, but they're just not responsive. That's when I say, hey, don't sign another waiver, because they'll come back and say, will you sign this waiver? It gives us another 6 months to finish the audit. Sometimes I've said no. Say, no, we're not going to sign the waiver. You need to complete the audit now. You've had ample time. We've been cooperative. So it just kind of depends on the facts and circumstances of the situation. I mean, if they're working with you and it's, you're dealing with complicated issues, yeah, maybe it's appropriate that you sign those waivers so that you've got that certainty. But if they're the problem, then I would say, certainly think about it or give us a call to talk about it. And if you don't sign a waiver, what happens? One of two things. Typically, the one thing is that they will issue a statutory assessment, say, based on the information we have today, here's an estimated assessment. Then, unfortunately, the burden of proof is on you as a taxpayer to say it's not right. So then you kind of have to sign a waiver so you can complete the audit and come to the right answer. But there are situations where that is appropriate. So definitely, don't automatically sign waivers. But if it's the first one, yeah, let them have it. Second one, maybe not. The next issue, Kay mentioned I was going to talk about exemption certificates. Exemption certificates, maybe not so important to this group because, again, most of y'all are it seems like in the services industry, but exemption certificates are important to document whether a sale and or purchase are not subject to the tax. And they're more important now than ever because of the whole Wayfair decision, which was, Kay referenced Wayfair earlier. It was a Supreme Court decision back in 2018 where the Supreme Court said that states can require remote sellers to collect sales tax in the states, even though they might not have a physical presence in the state. So if you're a manufacturer making sales into states throughout the country or to customers throughout the country, before Wayfair, you didn't have to collect exemption certificates because they were out-of-state sales. You didn't have physical presence in those other states, so it wasn't an issue to you. Now, though, with Wayfair, all but 2 states have adopted economic nexus provisions to say that if you make sales above a certain threshold in the state, then you have sales tax collection requirements. Well, if you're a manufacturer, obviously you're not making taxable sales, but if your sales exceed the 100,000 or whatever the state threshold is, the state can come after you and say, hey, document those sales. And so if you don't have the exemption certificates, they may assess the tax. So it's a really big issue now. So exemption certificates are extremely important. State rules vary, as far as, what they accept, how long they're valid for. Like in Virginia, they're valid forever. In Florida, they're valid, I think, for 3 years. So you have to be careful of this individual state's requirements. And you should really update your exemption certificates every 3 years, I would say, because some businesses go out of business or they, change hands. So it's important to have updated exemption certificates on file and in your possession at the time of audit, because when you obtain an exemption certificate after an audit has started, then it's subject to additional scrutiny. So you want to have it on file at the time of audit. And here, we've included a form, a Virginia Form ST10. It's a Virginia Resale Exemption Certificate. And the reason I included this is just to stress, be sure the exemption certificates are fully completed. Like at the top, it says 2. You want to be sure that's completed. You want to be sure they're dated. You want to be sure all the boxes are checked and everything is complete on here, as well as it's signed and has the title. Again, in order for an exemption certificate to be considered valid, it has to be complete. So complete. And Virginia has different exemption certificates depending upon, whether it's a sale for resale, if it's manufacturing, agriculture, research and development. So be sure that you pay attention to the proper exemption certificate and that you have it on file. And don't just arbitrarily accept an exemption certificate, because the state requires what they call good faith acceptance, meaning some they require dealers to, scrutinize what they're accepting, as far as an exemption certificate. Is this valid? I mean, is it to purchase something that should be exempt? For example, if you're a manufacturer, you've got a broad exemption, but if you're purchasing, say, a golf cart because you've got a huge facility and you need that golf cart to move your employees or visitors around, that golf cart is not exempt. Now, if that golf cart is used to move raw materials or finished goods or through the process, then it's exempt. But you just have to be careful of what you're purchasing. They're not very broad. They're not totally broad exemptions. So, and one other mention is of the MTC exemption certificate. Virginia does not accept this. Most states will, but you have to be careful with other states in that the footnotes, there's a second page, and second, third, fourth, fifth pages of the MTC certificate that you need to read to be sure that whatever state it is you're talking about will accept the MTC exemption certificate, because in the states, some of the states will say, well, it's only good in a resale situation. So again, you have to be mindful of the exemption certificates, what state you're in, whether they're acceptable. Virginia will accept other states' exemption certificates as long as they provide the same information Virginia's does, but they won't accept the MTC exemption certificate. So it's kind of an odd situation there, but just be careful with them. Now moving on to our polling question number 3. Which of the following are true about exemption certificates? They must be signed and dated. They should be received before the audit or even the transaction. They must be completely filled out, or all of the above. So please respond.
And then Terry, I'm going to talk real quick. Somebody asked about, do you have to have a hard copy of an exemption certificate? Like a paper copy? No. I mean, you have a scanned, you can definitely have a scanned copy of it as long as you can print it out and as long as it's completely filled out. I have an example where we sold inkjet printers at a company I used to work for, and we got an exemption certificate that somebody was in the business of selling clocks. And I'm like, well, you're not going to resell our inkjet printer, and we couldn't take it. So you got to take them in good faith effort and make sure that they actually are going to resell the product that you're selling them. Right. So we charge that person sales tax. So
right. And so I think we're probably giving everybody time to respond to the polling question. Do we have our results, Claire? Hopefully everybody said all of the above. Well, anyway, if you didn't answer D to be correct, but you can pick any answer will do. Good. Hey, you're listening. Good. So we're going to move on quickly because, typical Kay and Terry SALT presentation, we're pushing the clock and running out of time. We have a lot to cover still. But what to do in an audit situation? Do take this seriously. I mean, it's your time and money that's being invested in defending this audit. Time is just as important as the money, but the money can be significant in situations. Prepare in advance. Kate talked about that. And treat the auditor as a professional. I mean, they're doing their job. I mean, it's their job to audit you. Respect them for that. Challenge issues if you don't agree, and also seek professional advice or assistance if you're not making headways with the auditors, because they're not always right, but they probably think they're always right. So, just based on my experience anyway. But what to not do? Don't treat the auditor as a friend. It's nice to get to know them and to be friendly and to be nice and cordial. Sometimes it helps facilitate the audit process if you're nice to them, but they're not your best friend. Don't invite them to your holiday party. Don't be rude to them. Don't make them too comfortable. Don't give them the conference room with a view of the lake. They don't need that. They're there to do their job. If they're too comfortable, they're going to stay for a while, whether they're working on your audit or somebody else's. Don't give them free reign of the audit of your office. Say, here's the coffee machine, here's this, please limit your travel around the audit to these specific areas. Otherwise, if they're at in the cafe or the lunchroom and they overhear some conversations about new products, new services, they're going to say, oh, what about this? And they're going to, try to potentially assess new issues. Don't let the auditor dictate the scheduling. I mean, this is an audit of you. I mean, you have to work with them, but at the same time, if it's not convenient, and particularly these days with COVID, let them know. I mean, generally they'll work with you as long as it's not obvious you're trying to push this off forever. And another important fact is don't let the boss explain certain issues without some coaching in advance, because of course the boss wants to get, oh, we do this, we do that, and the auditor's going, oh my gosh, it's all taxable, and you're going, they really don't do all this, So be sure that with any type of interactions with higher ups who are trying to explain the process, that provide some sort of coaching that can potentially limit your exposure. Then in wrapping up the audit, what happens? Hopefully, the audit wasn't too painful. Everybody reasonably agrees, yeah, you might have missed a few things. You should have collected the tax or should have paid the tax. No big deal. You pay it and move on. There could be contested issues. You don't agree with the auditor's position on things. That's okay. You can contest issues. The interest always runs on audit assessments. Interest is mandatory. Penalties generally are waived on the first assessment, which is a good thing. Once you get past the first audit assessment, then you have potential what they call regular audit penalties and amnesty audit penalties. I'm not going to go into a lot of details, but penalties generally are only assessed on second and subsequent audits if the compliance ratios, meaning your effort of complying with the law, is below a certain threshold. So just if you've been audited once, try to get your act together and be generally compliant in the future. The administrative appeals process is one where if you can't work things out with the auditor, that you have the right to appeal the assessment to the tax commissioner. It's a very formal process. You write a letter, we write the letter for you, saying we contest these issues based on these facts. And you have to cite the facts, you have to cite the law supporting your position versus the auditor's position. Administrative appeals are a good way to resolve issues. I mean, it's a lengthy process. I used to work in the policy group with the Department of Taxation that handled the administrative appeals. And back then, a long time ago, it would take up to a year for taxpayers to get responses from the department. It still takes a year to get responses because the issues are complicated. And generally speaking, the policy group is trying to get to the right answer. It might not necessarily be what the auditor wanted or what the taxpayer wanted, but sometimes some middle ground. So something to definitely consider if you can't reach agreement with the auditors. Also, there's the issue of the gap period. That's the end of the audit period to current period, and sometimes it could be up to a year depending upon how long an audit has dragged on. Now, sometimes, and most of the time, auditors will say, well, do you want us to use your error factor, that we determined for the audit period, and apply that to sales and or purchases and bring it up to date, meaning, the audit would end as of December 9th, as opposed to maybe December 9 of last year. And that way, in considering whether to kind of bring the audit up through the gap period, it depends on what happened in that gap period. I mean, do you potentially have a lot of exposure that, yeah, maybe it would be good to use that error ratio from the audit period if it wasn't so bad and kind of cover that the gap period and those potential liabilities. Or if not, just say, no, we're going to end the audit and move on. So it's definitely something to consider. Hot audit issues, got a lot of them, and I have less than 5 minutes to cover them. Exemption certificates, we've talked about those. P-card, credit card purchases, this always is a key focus of auditors. They want to see credit card statements for the 12-month audit purchases sample period. So the key there is documentation. You need to have documentation to support those credit card purchases. And go ahead out now and get that, because if you're ever audited, they're going to want that. Use tax, Kay talked about that. Use tax is tax that should be reported by a company when a vendor does not collect sales tax on taxable sales to you. So again, if Keiter purchases computer equipment and say the vendor doesn't collect sales tax or use tax from us, we should be self-reporting use tax on those purchases, and you should be too. Anything you purchase that's not taxed should be, some tax should be reported to Virginia. It's not so much an issue since beginning in July of last year, 2019, when like Amazon began collecting sales tax on all their sales, regardless of whether it was an Amazon sale or third-party sale through Amazon. So it's not as much an issue now, but still it's important that you review your purchases to be sure that tax is being collected and or reported on the proper things. Sales and use tax rates. Now, Virginia has multiple sales tax rates. Central Virginia now has a 6% rate. Be sure you're collecting and or reporting the proper tax rate. Shipping and handling is taxable. Shipping, if separately stated, is not taxable. Handling, separately stated, is taxable. So that's an issue that we see recurring in audits, that auditors always pick up shipping and handling charges. So in most states, it's taxable. Samples and giveaways. Samples and giveaways are taxable to you as the person who's given away the samples or the giveaways. So use tax should be accrued in those situations. Intercompany transactions are treated the same as any other type of transactions. So if you have if it's intra, it's not taxable. If it's intercompany, like sales to a sister company or what have you, you should be collecting the tax. Say, and the situation typically arises where one might buy equipment and lease it to their sister or brother corporations, and sales tax should be collected on those situations.
And one thing to point out on this one is you may have two single member LLCs within an organization, and they may be brother sister companies, and they file all under one income tax return. That is only for income taxes. So single member LLCs or disregarded entities are not disregarded for sales tax purposes. So if you have intercompany transactions between two income taxes entities that are disregarded, you still need to charge sales tax. That's key to watch. I've seen some big issues with that with working with clients on this.
Yep, yeah, good point, Kay. Also, disposal of assets. I think we talked about that earlier. If you've got fixed assets and you've disposed of them, should you potentially be collecting sales tax on those? And then the final hot topic is software and documentation. Software in Virginia, if purchased by download or if it's a SaaS situation, it's not taxable. If it's a situation where you get a CD or some other tangible product from the seller, it is taxable. And the key here is documentation, because if the invoice says, delivered by a download or electronic delivery, you're good. But if it's silent as to the mode of delivery, or if there is a box that says FedEx charges, you're screwed. You're going to have to pay sales tax on it. So be sure that you are working with your suppliers to be sure that the invoices correctly represent what you're purchasing. I mean, most software these days is downloaded or it's SaaS, so it's not taxable. But if there's any doubt, then it's up to you as the purchaser to prove that it shouldn't be taxed. Other states are different in this regard, so just be aware of that. And finally, our polling question number 4, Claire, you'll put that up. Which of the following items should you not do during an audit? Prepare in advance, challenge issues proposed by the auditor, treat the auditor as a friend and give them anything they ask for, or treat the auditor as a professional. So if you'll respond to that question, we'll see if you've been listening.
There is one more question, Terry. If you have a corporate vehicle that is disposed of, say you sold in an auction for $200, do I report use tax? So if you're disposing of a vehicle, there is normally if you sell tangible personal property, the general rule is you have to charge sales tax. If there is an exemption for fewer than 3 sales of the same property, so if you're not in the business of selling vehicles and you only make 1 sale, then generally there's an exemption for you to not charge sales tax on that. But if you sell computers, like used computers to your employees on a regular basis, then you would need to charge sales tax on that.
Right, right.
Any
And
comments
if
there?
yeah, and if you use an auctioneer, generally the auctioneers are responsible for collecting the tax. So, I mean, if it's a situation where you're auctioning it off yourself versus using an auctioneer, you know, there might be a difference as to who's responsible for reporting the tax. Do we have a response to our last polling question there?
Yay. So everybody, yes, do not treat them as your auditor or your friend and give them, unless of course, as Elizabeth Lewis says, unless it's your financial auditor, you want to make sure you treat your financial auditors from Keiter nicely.
Yep. Yep. And we also had one comment from one of our auditor friends here at Keiter, and it says, we need to be sure that they need to be nice to your financial statement auditors. It's only the sales tax auditors that you need to keep at arm's length. So depending upon who's your auditor and what they're auditing, you know, think about your relationship. But I mean, generally, I mean, be nice, but you don't have to hug them when they walk in the door or give them a Christmas present. So yeah. And then I guess any last minute questions, of course, we run over, we always do. We appreciate your patience and your attending our seminar, your questions, they were great. If you have other questions, here's our contact information. Please reach out to Kay or me, and we're happy to talk with you about your audit situations or, you know, answer any other questions you have. But again, thank you for joining us today. And, you know, as long as you responded to your CPE questions, you'll get that CPE certificate. So again, thank you for joining us.
Thank you very much. Have a great day.
Bye.
Happy holidays.
Bye.